right, we're going to talk about active versus passive investments today. This is an offshoot of another video we did on mutual funds where we briefly touched on this topic, but wanted to give it a little bit more service for those that aren't familiar with the difference between those two types of investments. So let's start with active investments, as I think that's probably what people are most familiar with and has the longest history. So an active managed product is one in which a manager is given discretion over the investments that are selected. Oftentimes it's tied to some sort of benchmark, but they don't have to strictly follow that benchmark. And the traditional way we think of it is an investor that's trying to determine the underlying fundamental value of securities and then select and invest in them accordingly. So I made a simple example here. We've got XYZ stock and ZYX stock, and they're both trading at $40. And so the active manager thinks that over the course of the next couple years, XYZ is going to grow at 15%, then 10%, and then slow to 7% kind of in perpetuity. So as a result of kind of discounting those various growth rates back to the present, he thinks $50 is an appropriate price for that stock versus where it's trading at $40. So he's going to decide to make a 7% investment, let's say, in that security. Then we'll look at ZYX, again, also trading at $40. And the investor he or she thinks that this stock's going to grow at 10% next year, then slow to 5%, and then maybe only grow at 4% in perpetuity from there. So they're only going to assign a, let's say, $30 value to that stock. So with it trading at $40, they're probably not going to want to make a significant investment in that. So we're going to say they're going to put no amount of money into ZYX as a result of that fundamental assessment that they've made. So let's contrast that now with passive investments. So passive investments follow some sort of index or benchmark. Think something like the S&P 500. So in this particular example, we've got an index that comprises XYZ and ZYX, and each of them are a 4% position with that index. So the ETF, or the passive investment vehicle, pretty simple. As a result of the index owning that quantity of those two stocks, it's going to own 4% respectively of each of the two stocks. Pretty simple. This also brings up another type of investment that kind of sits between the two. So what's known as factor-based investing. And what factor-based investing seeks to do is kind of systematically target the factors that active managers often try to employ. We kind of used an example of a more value-oriented strategy, I guess, in the active example, where you're looking for stocks that are trading under what you think their intrinsic value is. So factor-based approach is looking to systematically achieve the same result. So again, we'll stick with value. So they'll screen for companies that have lower price to earnings or price to book value, other various measures of kind of valuation for securities, and seek to overweight those investments that display that factor and maybe systematically underweight investments that don't. So, another quick example here, again, same two stocks. XYZ is still 4% of the index, ZYX still 4% of the index. But let's say XYZ is trading at 10 times earnings versus ZYX that's trading at 15 times earnings. So ZYX is a little bit more expensive, or actually 50% more expensive than XYZ. So the ETF might systematically overweight, let's say, to a 5% position in XYZ, and then underweight ZYX at a 3% position. So contrast that with the active manager, where they made a significantly higher bet into XYZ relative to the benchmark at, say, 7%, versus having no exposure to ZYX. So if they're correct in that assumption, obviously that will be to the benefit of the active manager. But if they were wrong in their assessment, that could be to their detriment by either owning a security that XYZ, happens to go down and ZYX happens to go up, that would be negative for their performance, particularly measured relative to that index. All right, so let's kind of just summarize the concepts here. So again, passive investing seeks to track an index. And as a result of that, that's the lowest cost way to gain exposure to an asset class, say stocks, bonds, etc. And you're going to roughly track the performance of the index minus the trading costs and fees and some of the other associated components of it, but more or less track the index performance. Then we'll move on now to factor-based investing. So this gives you, I want to emphasize here, the opportunity to outperform the index through a systematic approach to gaining exposure to various factors, like we mentioned value, but things like momentum or quality, other various factors. So a systematic way to try and achieve those exposures that, again, active managers try to employ through their fundamental assessment of securities. But this tends to be much cheaper than traditional active management, but still a little bit more expensive than the passive investing. So again, the opportunity to outperform, but there again, you can suffer periods of underperformance relative to the index in a strategy like that. And then lastly, we'll go through, just summarize active again. So again, emphasis on opportunity to outperform the index through kind of giving the manager discretion to pick and choose the securities that they're selecting. Again, typically most managers will employ some sort of strategy, be it growth or value or quality, that those factor approaches are trying to systematically gain exposure to. But the downside here, again, is those strategies can underperform relative to the benchmark, and oftentimes, historically, most active managers do tend to underperform the benchmark because of the higher fees associated with those. So active management is going to be the most expensive of those three options because you're paying someone to pick and choose those securities, and they usually have a stable of analysts and other traders and other people in their employ that are trying to engage in the investment selection there. So that is our summary of active versus passive investing, and also the mix-in of factor-based investing, which kind of lives in between